The CPI report came out. How are markets responding to this? Does it mean we are going into stagflation? Or does it mean that we might avoid stagflation? The first thing that I want to discuss, of course, is the CPI report. So, for those of you who don't know, let's head over to CNBC. And it actually was lower than expectations. So, right here, Consumer Price Index rose 2.8% in February from 12 months earlier, a deceleration from January. So I want to point out the CPI understates inflation. Everybody knows it, everybody gets it. But I do think it's an important number to get a feel for the trend. And are we in a disinflationary trend? And remember, nothing goes up or down a straight line. Are we in a deflationary trend, or are we in an upswing in inflation like we saw in 2021? And you guys know from watching my videos, I've been kind of in the deflation camp from 9% down to, pretty much all the way until it got to about 3. And I was like, yeah, I don't really see a catalyst for the CPI going significantly higher or a reacceleration of inflation. And then I also don't see any reason why we would continue this disinflationary cycle unless we get more of what we saw during the cerveza sickness, and then I would lean more towards a reacceleration of inflation, or we get a recession, something that reduces economic output, aggregate demand, and like the unemployment rate going up. And then, okay, now I'm leaning more on the disinflationary camp, or I'm more in the disinflationary camp, meaning that I would not be surprised if the CPI goes sub the Fed's 2% target. And in the interim, until we get one of those catalysts, I was like, I don't know. I mean, for me, my base case is that we just kind of float between 3.5 and, between 2.5 and 3.5. So it's kind of the way that it's played out really over the last, let's call it, year. But we go back down to 2.8. The expectations were for 2.9. So it's not a huge miss on the downside. But, is this a trend down lower? Is this just noise? We're going to continue the trend back up when we went from 2.4 up to 3. I don't really think you can conclude this is one or the other. I just think nothing goes up or down in a straight line. Next key talking point, steel and aluminum tariffs took effect Wednesday. Economists fear that escalating trade war could stall or reverse progress on inflation. So the progress on inflation they're referring to is the CPI coming from 3% down to 2.8%. Now we're going to go over some of the details of inflation, and honestly, it's a head scratcher as to how on earth they can get to this 2.8 number. And again, I think this understates it. I think the trend, we can extrapolate data from that and say, okay, the trend's probably lower, but I don't know how they get to this 2.8 number based on the other data points that they use in their formula to get the 2.8 to begin with, right? So eggs, no shocker here, saw by far the highest inflation rate among other categories in February. And of course, they've got this gal checking the eggs here. I don't know why everyone doesn't buy their own chicken, but we'll save that for another video. So the punchline is the breakdown of the overall year-over-year prices. So when I was saying 2.8, that's year-over-year. The actual month-over-month was 0.2. The expectations were for 0.3. So you can see all items combined, we've got 2.8%. Food at home, and this year-over-year, 1.9%. Food away from home, 3.7, and all items less food and energy, 3.1. But here's where I'm a little fuzzy on the math, to say the least. Now, I almost flunked out of high school, as most of you know. I've never taken an econ class. I've never taken a finance class. I'm by no means a math genius, but I'm struggling connecting the dots. So those of you who are good at math, maybe you can help me out with this one. So the highest increase in the overall basket was eggs, like I said, 58.8%. 58.8%. But the second, beef roasts, 9.5. It's not like that's low. Coffee, 8.6. Ground beef, 7.8. And you can see all the way down to oranges at 2.8. So based on what they've shown us here, the lowest increase was 2.8%. The highest was 58.8, but yet somehow the average is 1.9. So the average is basically 1% lower than the lowest item on the list, which is again oranges at 2.8%. Now, I would assume the reason this math doesn't really add up is because there's things that they believe went down in price, but why wouldn't you put that on the chart? Like if I'm CNBC or if I'm giving the information to CNBC, wouldn't I want to put like half of the items, increasing in price and then show the other 50% that were decreasing in price? Why would I omit all of the line items that decreased in price? I mean, it would seem as though even if the numbers didn't average out exactly, that at least that would make a little bit more sense as to how they got that 1.9% to begin with. Or I don't know, maybe it's just government math that it's like it's not even like reverse engineer. I was going to say they come up with a 1.9% and then they reverse all the other numbers to get there, but you're not even reversing the other numbers because we're not even remotely close based on what we have here at 1.9%. So it's a bit of a head scratcher. Maybe I'm not doing the math right. Maybe it is mathematically possible to have a 1.9% average when the lowest price increase is 2.8%. You guys let me know in the chat. I mean, it's look at this. Energy negative 0.0, negative 0.2%. Oh, fantastic. Great. Our two inputs are a plus 6% and a plus 2.5. That dog don't hunt. And again, I get it here. The most reasonable explanation for this is they just omitted all of the things that went down in price. But why would you not add that to the list? Why would you give me a list that is so far off what the overall average was for that entire category of goods or services? Here we go again. All items less food and energy are, we're in there at 3.1%. Our highest is up 20.8%, and our lowest is up 5%. It's just bizarre. Here we go. Michael Puglisi, senior economist at Wells Fargo, said progress is bumpy. Yeah, I'll give him that. Nothing goes up or down a straight line. It's not a linear path down. There still are risks, but there are no signs of reacceleration with the data in hand. Come on. These analysts, can you please just have an original thought, please? I mean, basically, if you want to know what an analyst's opinion is on something, just take whatever the data has said over the last week, and that's what's going to be their opinion on what will happen indefinitely into the future. So I guarantee you this guy, I mean, if he would have, this is probably the guy that last week was saying, well, everything points towards stagflation. Everything points to a reacceleration of consumer prices just because we've seen 2.4 to 3. And now all of a sudden we have this, and he's like, oh, well, there you go. Pretty obvious. Nothing's linear, and we don't have to worry about inflation anymore. I'm not saying that's my position, but it's like, just please, could you have an original thought? I don't know. What are you analyzing, right? Like if all you do is just parrot whatever has happened over the last 3 days, like what are you actually analyzing? It's I guess that's how they keep their job. That's the bottom line. And Chris and I talked about this the other day. Chris Irons. It's like they're talking about how the central bank aims for 2% annual rate over the long term. All right. So are you going to tell me that if we're at 2.1%, then they're going to be freaked out about inflation in the 1970s? And then if we're at 1.9%, then they're going to be equally freaked out. But instead of the 1970s, they're going to be worried about the 1930s. If we just have 2 basis point delta or 3 basis point. I mean, it's like, come on, this 2% target, it's so ridiculous. If you just think about it for more than 30 seconds and you're above 10 years old, it's like, this makes no sense whatsoever. I mean, when are we just going to point to the emperor and admit that he's not wearing any clothes? Hey guys, I wanted to take a quick break from the video to share with you a new investment strategy I've been using. Most of you know the cornerstone for my portfolio is physical gold. The problem is you always have a negative carry because you have storage fees. Same thing with silver. But I've actually found a way that you can be paid to own physical gold and silver. And here's the best part. You're not just paid an interest rate in fiat currency, you're paid an interest rate in more precious metals. Now, I know a lot of you are saying, oh, Georgia sounds too good to be true. And it's exactly what I thought when I first heard about this. Here's the backstory. I get a lot of businesses that come to me and say, George, we want to sponsor your videos. Usually I turn them down because it's not really a good fit. But I had a company come to me the other day called Monetary Metals. And when they were walking me through what they do in their business model, I thought to myself, this is a complete no brainer. In fact, it sounded so good, I set up an account myself and it's been going extremely well. So I said, sure, sponsor a couple videos because this is a service that I think would be hugely beneficial to my audience. So here's how it works. You can go ahead and set up an account with them and fund it with your existing precious metals, or you can buy directly from them, usually a little less than 1% over spot. And right now, as we speak on the platform, there's opportunities to be paid about 4% interest. So again, this is not in fiat currency. They're paying you in additional precious metals. So if you deposit, let's say 100 ounces of gold with them, at the end of the year, you'll have 104 ounces of gold. So to join the thousands of investors, including yours truly, who are being paid to own physical gold and silver, you can go to monetary-metals.com/gammon. That's monetary-metals.com/gammon. So now they're talking about Trump's tariffs. And, I don't like Trump's tariffs from an economic policy, or as far as an economic policy, you guys know that. But are they going to create massive inflation? No, I don't see how they do that unless you have M2 money supply or the extension of credit really kick it into high gear. In other words, the banks would have to play ball. And if the banks are out there and all they see is risk, they're not going to lend into the real economy. And that's not going to create enough money supply to go down and support higher prices in terms of wages, right? Because you would have to have those margins increasing or at least staying the same so they could afford the higher wages. Because what happens in order to get higher wages, if the suppliers or if the employers, the corporations, the businesses, if they're not making more gross revenue, then the only thing that you have there, the only variable, are your profit margins. But your profit margins can only go down to a certain level, right? Before you just have to start firing employees. So you can't just keep raising wages and get this wage price spiral that they always talk about. You have to have those businesses taking risks. You have to have the banks taking risks on the businesses and lending them money. And therefore you can, and I'm not saying that's a good thing. I'm just saying if we're just strictly looking at how prices go up and reaccelerate, I don't see how you do it unless incomes go up. And I don't see how you do it unless there's more risk taking by the entrepreneurs, the businesses, and the banks themselves. And I kind of use M2 as a very, very broad proxy for that. So why am I not that concerned about consumer price inflation with tariffs? It is very true that if you tariff every single thing at Walmart, the price will likely go up, especially if you do it by 25%. If you put a 1% tariff on it, then that's not going to have as dramatic of an impact, obviously. But if you put like a 25% tariff on everything at Walmart, just using that as an example, you're going to see prices go up there. But again, if you don't see incomes go up, then those people are going to, let's assume they have to buy that stuff from Walmart to put food on the table. Well, they're going to have to take that purchasing power away from somewhere else, because what's happening at Walmart is taking a higher percentage of their paycheck. So although the stuff at Walmart goes up, other stuff goes down, and you get the unemployment rate going up because they're taking aggregate demand away from the discretionary spending. I always call it, if the things that you need go up, most likely the things that you want will go down. So here they're talking about basically, CNBC and the mainstream media is all about Trump is bad, tariffs are inflation. That's any negative thing that they point out in the economy, they always say it's because of tariffs. And again, I don't like tariffs as far as an economic policy, but it's not, come on, it's not the reason why we have every single negative data point that we have. Like, as an example, the unemployment rate went up the other day. You can't say, oh, well, obviously this is because of tariffs. I mean, maybe there's a slight component in there, but what they do is just like, okay, unemployment rate, well, that has to be 100% because of tariffs. Egg prices are up 59%. Well, that has to be 100% because of something Donald Trump is doing. Here's a chart, and if you want to look at less food and energy, which I don't know why they exclude that because of the two main things that people need to survive, but that ticked down to 3.1%. And like we said earlier, headline CPI down at 2.8. So let's go ahead and see what happened in markets. What was the result here? You would assume that bond yield, the 10-year treasury, would go down. It's interesting, about flat. Not much happened. Although I commented on this on Twitter and I said, the people at CNBC, they obviously have some DEI hires over there. And the reason I said that is because of this headline. Get this. You guys will get a kick out of this one. Treasury yields gain. In other words, the yields went up after CPI report eases stagflationary concerns. So stagflation, in other words, inflation going up and up and up like we saw in the 1970s, because there's a lower probability of the 1970s, which is the most inflationary decade in United States history, or at least in the recent history, then that means that's why treasury yields went up. Obviously, I'm joking here, guys. It's obviously the opposite, right? If you wanted to pin yields, or if you wanted to give an explanation as to why yields went up, you would not say because inflationary expectations went down. This is just complete nonsense. And so I don't know who writes this garbage, but my guess is they weren't hired based on merit. Just a guess. Just a guess. Anyway, getting back to markets. So we're pretty much flat, although NASDAQ, as you would expect, up more than the others because, okay, maybe we see lower interest rates. Maybe Fed funds goes down a little bit more. Maybe we see an easing there. And that's why you have NASDAQ up 212 points, which is great unless you kind of zoom out and look at what the NASDAQ has done lately. We'll look at a chart. And most of you guys know from watching my video that that's an ugly chart right there. That is the no bueno zone. So we're right up here at, call it 20,000. And then we just right off a cliff, Wile E. Coyote. And then we did just bounce slightly, but I don't know. If I was long the NASDAQ, I don't know if I would find too much comfort in today's price action. That is looking at lower lows and lower highs. And, it's funny because I was in St. Bart's over the weekend and I was talking to Steve and some of the other guys like Hugh and pretty much every hedge fund manager that I was talking to out there. They're like, we don't buy when a chart looks like this. Like, we just don't, as far as the overall market. So if you have a market that's trending down, in other words, lower lows, lower highs, most of the big money, now there might be some that try to catch a falling knife, but most of the guys that I talk to that are, these that ran just tens of billions of dollars and did it very, very successfully over decades, they say when they see a chart like this, especially in the NASDAQ, they're on the sidelines. They're not going to play until we see a reversal of this trend where you start to see higher highs and higher lows. And so my next question was, well, who's going to hit the bid here? And they said, it's got to be passive. It has to be passive. And that actually gives you quite a bit of clarity, because I was just talking to Jason Hartman about the housing market. We were talking about how many variables there are, and it gets very confusing because there's all these cross currents, especially in 2025. But when you can isolate the NASDAQ or the S&P 500, and you can look at a chart like that and know that probably 90% of the discretionary is going to be on the sidelines until that chart changes. And then you ask yourself, what would prompt the passive, meaning the strong retail, to come in and buy this dip? I'm not saying it's impossible. I'm just saying when you're trying to consider the psychology and what would likely reverse that trend, you've got to think about what is really going to motivate and create that greed within the retail investor to where they'll put more money into passive, and then passive just hits the bid, because it's just like Mike Green says, it's just $1 in, I buy $1 of stock. I mean, the year chart doesn't look very good. I mean, you could say maybe there's some support here, but I'm no technician. I can just regurgitate to you guys what the guys that I'm talking to are saying about the overall markets here. So getting back to the other markets, let's go to Bitcoin. And Bitcoin 83. So I know it was kind of back and forth all day. We're flat. The chart there doesn't look very good either. This is kind of what I would expect with the Nasdaq being up slightly for the day. Gold, pretty much flat as well, and oil, same thing. So not too many movements here, even though the CPI came in a little lower than expected.